The American airline industry is a highly competitive yet heavily regulated battlefield where no company by design can ever capture majority market share. No airline has greater than 18% market share, and any M&A deal that would bring that number to 20% or higher is automatically blocked by the Justice Department. Yet while the core customer experience has not changed, American Airlines have gone through an often overlooked evolution in the past decade. It was only 10 years ago when newer low-cost carriers like Southwest and JetBlue were celebrated as innovators, disrupting dominant legacy carriers like Delta and United. They had elevated product and value with extraordinarily cheap fares and unprecedented amenities like free checked baggage, extra legroom, and self-assigned seating. Americans voted with their wallets, and they flocked to these no-frills, low-cost carriers where the experience was comparable and the price was consistently lower. Airlines are a straightforward, capital-intensive business where volume and scale is everything. The more planes, the more seats, the more passengers, the more trips, and the more money you can make. If we were to rank all American airlines based on earnings, the carriers that make the most money are the ones with the largest fleets, and those with the least amount of revenue generally have the smallest fleets. Like cruise ships, passenger aircraft are expensive assets that cost hundreds of millions of dollars and are built by only a few suppliers in the world and must be ordered years in advance. Every fleet costs millions more in annual maintenance, and planes generally are replaced after 20 to 30 years. Yet the airline business is not as simple as buying the biggest planes possible. For domestic flights between 1 to 6 hours, frequency and flexibility reign supreme. Single-aisle, narrow-body aircraft work best as despite the fewer seats and minimal service, they can be filled and emptied quickly. For long-haul flights, wide-body two-aisle aircraft are ideal as they possess the range, have space for cargo and meal service, and can seat twice as many passengers. But on the flip side, they hog more fuel, require more crew, and take longer to turn around. There's no right way. You can get lots of people from A to B in a single shot in one big plane or distribute passengers across many small planes over time. The path to profitability is to fill every plane you have with as many passengers possible. Yet no airline can sell out every single flight all the time. Load factor is the industry metric for seats filled, and 100% is near impossible. Across all American airlines, the average load factor has hovered between 70 to 80% for the past decade, meaning roughly 20% of seats are unsold. But beyond supply constraints and the high fixed cost of aircraft, variable costs are just as expensive. Fuel is the most expensive operating expense and chews up roughly 30% of revenue for every single airline. Every carrier spends billions of dollars every year for billions of gallons of fuel, and the cost savings are negligible for even the biggest carriers who operate with economies of scale. After fuel, the second highest expense is labor, as critical staff like pilots, attendants, and mechanics are all generally unionized. They secure higher pay and better benefits every few years, all of which mean ever-rising labor costs. Even though more people are flying than ever before, there's little margin left once all the bills are paid. Add in labor shortages, supply chain delays, regulation, weather, and the reality that the most lucrative airports and routes have been dominated for decades by the legacy carriers, it's no surprise why airlines remain an essential service but an unpopular business. No matter how you slice it, it's a tough market, and carriers all around the world have to constantly prove to investors that they're worth the investment, and they hand out generous dividends year after year to show a better return on capital. All this made the emergence and the overperformance of low-cost airlines in the 2010s all the more impressive, as they consistently outperformed the old-school legacy carriers in profits and loyalty, with fewer planes and marketing spend. Across universities and the private sector, these low-cost carriers were celebrated as leaders in strategy, innovation, and culture. The popularity of Southwest, JetBlue, Spirit, Frontier, and borderline Alaska all pointed to this low-cost future where the airline with the best price would always win. This theory made sense as online aggregators like Expedia, Trivago, and Kayak were all taking off at that time, and it was easy for anyone to find the cheapest option for any flight. There was a feeling that this was a changing of the guard, and the low-cost carriers would be the successors for domestic travel. Investors poured their optimism into these airlines, and for years, these low-cost carriers traded at higher multiples than the legacy carriers. But fast forward to present day, and this low-cost future has not materialized. The low-cost carriers are all struggling. Some are on the doorstep of bankruptcy, and the legacy carriers are now back on top both in earnings and valuations. With their backs against the wall, the low-cost airlines are in panic mode, and they're all asserting that the industry is rigged, and there's no way for anyone to beat United or Delta. Is the American airline industry really rigged? How exactly did the legacy carriers reclaim market share? In this episode, we'll dive into the American airline industry and the territorial battlegrounds through the lens of 7 different airlines: United, Delta, American, JetBlue, Southwest, Frontier, and Spirit. Legacy carriers like United and Delta all operate off the hub and spoke model. We've covered the inherent scalability of hub and spoke networks on Modern MBA before. That's how Western Union and MoneyGram can enable so many people to send and receive cash at so many places around the world. Airlines pick a handful of airports across the country and convert them into strategic bases to centralize their planes, passengers, and resources. Passengers are funneled to hubs, and those who are too far must lay over and catch a connecting flight at the hub to reach their final destination. Airlines can ensure higher load factor and profits by consolidating the passengers into one location with big aircraft and then packing each cohort onto smaller, more fuel-efficient narrow-body aircraft based on their final destination. Airlines also use hubs as a home base to consolidate repairs and maintenance, rather than having to keep mechanics and parts at every single airport that they touch in their network. They can also flexibly swap planes in and out at hubs to keep flights moving whenever unforeseen problems arise. While centralization always leads to greater cost efficiency, the entire network on the flip side becomes dependent on the hubs. If a hub suffers any downtime through weather, labor shortages, or just local projects, these delays will ripple through and the entire network suffers. The complexity in aviation is that airlines don't own airports, and airports are public properties managed by a city or state. This means that airlines have to work within the constraints of the airports as they've been built and spend hundreds of millions of dollars to renovate and improve the areas that they lease. Carriers ultimately must be strategic about which airports to convert into hubs. Airports that are too remote or too small just won't be as effective. On the West Coast, SFO and LAX connect California, the world's 5th largest economy, to the rest of the country, and also double as gateways to Asia and Latin America. In Middle America, there's Denver, Chicago, and Dallas-Fort Worth as midpoints between the West and the East, along with the North and the South. On the East Coast, there's JFK and Atlanta as gateways to Europe, South America, and the broader Eastern Seaboard. The location of these airports and their proximity to wealthy metropolitans, thriving industries, and large populations make them strategically more valuable than anywhere else in the country. While the DOJ ensures that no American airline gains over 20% of the overall market share, it doesn't enforce on a per-airport basis. Over the decades, legacy carriers like United, Delta, and American have all turned some of their hubs into fortresses through first-mover advantage. In a fortress, one carrier dominates most of the routes and in turn can raise prices as passengers have no alternatives and must go through this one hub and this one airline to get to where they're trying to go. United's hubs are San Francisco, Chicago O'Hare, Newark, Houston, Washington, Denver, and Los Angeles. Delta's fortresses are Atlanta, Minneapolis, Detroit, Salt Lake City, Boston, JFK, and Seattle. And American's hubs are Charlotte, Dallas-Fort Worth, Miami, Philadelphia, and Phoenix. These airlines were all first movers at these airports, and they benefited as the industry consolidated through the 2010s. It would be impossible to compete with any of these legacy carriers at their fortresses. If you wanted to go head-to-head against United and SFO, you would have to burn billions of dollars, undercutting United on prices, spinning up operations, burning fuel and wages, somehow getting the same gates, and flying identical routes and schedules even if your planes are mostly empty. It would be the same losing battle if you attempted to challenge Delta at Atlanta or American at Dallas-Fort Worth. Not every hub is a fortress, and certain hubs to this day are still contested. For instance, Delta and American have squeezed United out of New York entirely, which led United no choice but to bet the farm on building a fortress in the neighboring New Jersey. Ultimately, because these legacy carriers have established fortresses all around the country that complement their networks, they all have the capital to contest certain hubs and concede other airports in ways that no other airline can. Through the late 2000s and into the early 2010s, the legacy carriers all focused on expanding international routes to strengthen their fortresses. While the majority of revenue still came from domestic travel, United, Delta, and American were all eager to woo the premium business traveler, as working Americans had been hit hardest in the Great Recession. The 3 airlines collectively invested billions of dollars into transatlantic and transpacific products, renovating existing planes with lie-flat seats for business class, forging alliances with overseas carriers, opening up direct services to major destinations overseas, and building high-class lounges at airports. No airline in the world has the same fleet, planes, routes, workforce, and hubs. Thus, every carrier has their own pricing, costs, markets, and break-even points. Hence, it's impossible to evaluate airlines based on conventional revenue and profit. Instead, the airline industry revolves around two metrics: RASM and CASM. They're measures of earnings efficiency which account for volume, capacity, and distance. This enables comparison between airlines, regardless of if someone has 10 planes versus 500 planes or flies to Tahiti versus Idaho. RASM is revenue per available seat mile. It adds up all the revenue streams: tickets, bag fees, Wi-Fi, onboard sales, change fees, etc., and then divides that by the number of seats per mile flown. RASM asks how much income did you squeeze out per seat per mile flown, inclusive of the seats that you didn't sell and everything that you charged to that passenger. The higher your RASM, the better. And one surefire way to increase RASM is through business or first class seats, where a single seat can be sold for 3 to 5 times more than economy, and even higher on international long-haul flights. RASM for all legacy carriers grew year over year into the 2010s on the heels of such investments. CASM is cost per available square mile. The higher the RASM and the lower the CASM, the greater the profits. Any airline can boast fast-growing RASM, but won't be able to hide from growing CASM if they're flying half-empty planes on routes that could be generating more money elsewhere and not managing down their costs. This was ultimately why the legacy carriers aggressively cut back on domestic capacity in this time period. Americans could still get around, but there were increasingly fewer options, more transfers, and longer travel times. United, Delta, and American were at peace with this trade-off. From their perspective, the average American in the 2010s was now only loyal to Expedia, Kayak, or Google Flights. The exiting of the domestic markets and the price transparency of online travel aggregators widened the opportunity for low-cost carriers to thrive. Southwest, Frontier, JetBlue, and Spirit exploded as they all suddenly now had the platform, product, and visibility to win mainstream consumers, showing up at the top of organic searches as the cheapest and fastest options. This would usher in the golden age for low-cost airlines. There's only so many ways to cut costs while still leaving enough meat on the bone. Use cheaper, narrow single-aisle planes, install only essential equipment to keep maintenance low, focus primarily on domestic travel, pack as many seats as humanly possible onto each plane, seat all passengers into one cabin class for fast turnaround, use minimal staff, and get from A to B as quickly as possible. Low-cost carriers all operate on a point-to-point system. Every flight is an independent connection with no hubs. As long as there's a gate at origin and destination, a low-cost carrier can squeeze in. Even at fortresses, there are still gates available for other airlines. They're just generally not available at the times that most people want to travel. This works for low-cost carriers because their customers are willing to fly at inconvenient hours in exchange for cheap airfare. But without that intermediary consolidation, point-to-point networks are constrained at scale. There needs to be enough demand from A to B, yet there are only so many city pairs within the US that have such a volume, and adding a new connection requires far more routes than the hub and spoke. The cheapest airlines are Spirit and Frontier, whose airfares are on average 2 to 3 times less than the next airline. These two carriers combined today hold less than 10% of the domestic travel market and have plateaued in their market share since. Both carriers have been building up their fleets since the 2000s, but still remain amongst the smallest airlines in the country. With fewer planes, their approach is identical, in flying few trips a day, but making sure that every flight is high density and high efficiency. This can be seen in load factor, where Spirit and Frontier each feature industry-leading load factor simply out of business necessity. Because there are so few flights and planes, these carriers would rather delay their flights rather than cancel them, and they prioritize completion over being on time. Spirit's go-to-market strategy is simple. They look at any city pairs with over 200 passengers a day and then sell tickets for 25% cheaper than the competition. Through the 2010s, Spirit established itself as the cheapest game in town despite the rising fuel and labor costs. By design, the company would make up the lost fare revenue by pushing ancillary purchases and unorthodox customer behavior. There's fees for just about everything on Spirit, when you book online or when you ask them to print out your boarding pass at the airport. Customers had to pay tens of dollars more for a carry-on, or simply just not bring any bags at all, which meant fewer staff, faster departures, lighter planes, and less fuel consumption. As long as the total cost to Spirit customers was cheaper than that of the closest competitor, the company could aggressively push ancillary fees and maintain growth. Spirit did just that, and overall non-ticket revenue surpassed that of airfare year over year. Passengers spend more on average on extra fees than they do on the plane ticket itself. Yet the spread between RASM and CASM reveals the thin margins of the low-cost model compared to conventional airlines. Even without hubs, Spirit still needed airports to base crews out of, and it could only play the cards it was given. They chose the emerging airports of Fort Lauderdale and Orlando to support its operations in the South and stayed clear of American's Miami fortress. Spirit had the most success in occupying mid-sized airports that most airlines didn't actively service, like Las Vegas, New Orleans, and Atlantic City. Leisure was really the only primary play with this kind of network. The marketing followed suit as Spirit pushed cheap getaways to Sin City or the Sunshine State. Their path to growth was not west, but instead to go further south, building on its core Florida customer base. As Spirit progressed into the 2010s, the airline expanded with flights to the Caribbean and Latin America. Frontier followed an identical strategy, taking up market share in Orlando and Las Vegas and made up for its low airfare through the same aggressive ancillary purchases. Yet timing still mattered most. If Frontier entered an airport where Spirit, Southwest, or JetBlue had already established their market share, it would be bad business as everyone would be pulled into an unprofitable race to the bottom. The highest profit was instead to find the underserved markets where the only competition was from legacy carriers. This is why Frontier focused on airports like Cleveland, Tampa, Phoenix, Cincinnati, and Philadelphia, where they would be the cheapest and only low-cost game in town, no different from how the legacy carriers built their empires generations ago as the only airline in town. Ultimately, the passenger spend between Frontier and Spirit are near identical, with a delta of just a few cents. The only distinction between the two are really in their networks and fleet sizes, rather than their branding or messaging, as even their operating margins are similar. While Spirit and Frontier cut everything down to the bone, it was actually Southwest who was the biggest beneficiary of this new low-cost trend. They grew from $500 million to the busiest airline in the country in just 5 years. What put Southwest on the map was its revolutionary policy, where passengers could check 2 bags for free, an amenity that no carrier ever dared to match. It made no sense to openly throw away this high-margin ancillary revenue, to compel passengers to bring more than what they needed, and to increase your own labor costs by accommodating all these bags before and after every flight, and burn even more fuel weighing down planes with all this luggage, all while pushing low-cost airfare. To offer such amenities while fuel prices had reached record highs during the Great Recession was a move seen as both radical and unsustainable. Yet the bet was that this would generate loyalty beyond price, elevate Southwest above its low-cost rivals, and encourage regular air travel amongst the American middle class. As the grandfather of low-cost airlines, Southwest understood best that full planes was ultimately all that mattered. They would rather have the passenger than not at all, and subsidizing luggage was the price to pay for more butts and seats. Southwest snowballed free luggage into a greater message on not just value, but also customer service and affordability. They were uniquely the one low-cost carrier that didn't nickel and dime passengers, that was proactively transparent about fees, and didn't package essentials as ancillary purchases. Average airfare on Southwest was still cheaper than legacy carriers, but marginally more than Spirit and Frontier. Americans fell in love with the perks, and the carrier surged to valuations higher than that of the legacy airlines through the 2010s. But contrary to business case studies and LinkedIn influencer fortune cookie slop, the baggage policy was not why Southwest succeeded. It was certainly a winning contrarian bet that deserves its praise, but it was merely a growth accelerant. Southwest was the first ever low-cost carrier. They had pioneered things that would later become standard practice, like open seating and single cabin. But by the time Spirit and Frontier arrived on the scene, Southwest already had dominant or second most market share in the airports like Las Vegas, Phoenix, Baltimore, Denver, Dallas, and Chicago. Even at fortresses like Atlanta, Southwest boasted the second most market share. Compared to the other low-cost airlines, their point-to-point network was simply much more mature, expansive, and its fleet of planes was just that much bigger. Free baggage amplified growth, but none of that would have been possible in the first place without these core building blocks. But before Southwest, there had been another airline who had attempted the same playbook of combining value and elevated in-flight experience. That was JetBlue, who was the youngest low-cost carrier on the scene. They focused on differentiation through not just affordability, but also experience, with all new planes, leather seats, free satellite television, and extra legroom all in coach. While its rivals fought over proven mid-sized airports, JetBlue went all in New York City in the early 2000s and bet everything on an emerging airport by the name of JFK. Compared to LaGuardia, JFK was cursed. It's twice as far from Manhattan, and commutes could take hours. Thus, legacy carriers ignored JFK and continued to fight for slots at the already congested LaGuardia. JFK continued to languish through the 90s despite New York's best efforts. When JetBlue finally showed up, the state was overjoyed. They finally had a carrier that was not only willing to embrace JFK for domestic travel, but also make the emerging airport its base of operations. New York State gladly bent the rules, and they awarded JetBlue a lion's share of JFK's slots. For JetBlue, it was a logical bet in this turf war. They were aiming to be the cheapest airline in New York City, and asking passengers to commute longer to achieve those savings was a small tax to pay, and having these slots meant reducing the risk of direct competition. On the West Coast, JetBlue did the same with Long Beach, as another historically underutilized, high-potential airport and where the local government was more than willing to cut a deal to popularize the venue. As New York City rebuilt itself after 9/11 and the fears around air travel dissipated into the 2000s, JetBlue quickly thrived as New York City's cheapest airline. But to maintain growth, JetBlue needed to diversify beyond Manhattan. They believed they had the hard product and the low cost to go toe-to-toe with any carrier in any market. JetBlue pursued the usual suspects: suits in Boston and DC, vacationers in Florida, and locals in Los Angeles, all of which helped maintain earnings even as direct competition grew at JFK. But JetBlue was looking for more than just top-line growth. They wanted stronger RASMs and higher profit margins. The only way to achieve that was to go upmarket, where the airline would no longer be constrained by the realities of low-cost pricing. By the mid-2010s, JetBlue had pushed out Mint, its luxury lie-flat front cabin experience for transcontinental flights. Mint was for the underserved business owner or high-end leisure traveler who didn't fly frequently enough to have status with the legacy carriers. And profit margins quickly grew into the 2010s as JetBlue repositioned itself from a low-cost carrier into a premium airline. United, Delta, and American had long appeased Wall Street with cost-cutting, share buybacks, and dividends, but everyone knew they were maintaining their moats at best. In 2016, United and Delta replaced their leadership with new blood, eager to usher in new regimes. These new CEOs bucked the old-school penny-pinching mindset, and they were willing to maximize profits rather than minimize losses. Historically, their predecessors had only ever optimized for the short term. Whenever a domestic route declined in profits or popularity, they would naturally reduce the schedule and outsource the flights to small regional contractors. This would further reduce profits to the point where the entire route became unsustainable and had to be eliminated from the network, thereby conceding domestic market share, all in the pursuit of saving a buck. The only advantage that the low-cost upstarts had over United, Delta, and American was in pricing. People wanted cheaper fares. That much was obvious. The legacy carriers had already conquered the top of the market with their loyalty programs, corporate accounts, and networks. What they needed now was to lean into the bottom of the market, and their answer was in tiered pricing. The airlines took inspiration from Apple, who by 2016 had split their flagship iPhone into 3 separate tiers for the first time ever. Smartphones had become a commodity, and like the legacy carriers, Apple had the top of the market in their back pocket, but needed the broader adoption and volume to keep sales up. There was the barebones SE at $399, the standard 6S at $649, and then the top-of-the-line 6S Plus with the latest and greatest at $749. The legacy carriers lifted and shifted this good, better, best pricing structure to the economy cabin. Historically, economy had been a single, all-encompassing cabin that everyone sits in after business class, but with tiered pricing, economy was reinvented into 3 distinct products. By 2018, United, Delta, and American had rolled out basic economy, regular economy, and premium economy to all domestic flights. Budget-first passengers could now find comparable fares through basic economy, where carry-ons are only allowed for an extra charge, which unlocked the same operational efficiencies that Spirit and Frontier had built their companies on. Yet basic economy wasn't about price matching. Rather, the legacy carriers competed on their age-old strengths: fortresses, hubs, loyalty programs, frequency, and schedules that the low-cost airlines could never match with their smaller fleets and smaller market share. As long as there was a cheaper offering, passengers would have ample incentives and adequate savings, buying a slightly more expensive basic economy from a legacy airline over a one-off with a low-cost carrier. This rapid 2-year rollout generated greater domestic optionality for passengers, but more importantly, cut into the moats of the low-cost airlines. These new pressures pushed the low-cost airlines to bring their fares down even more to maintain their edge. While Americans continued to fly whatever airlines that fit their schedules and needs, the profit margins of nearly all the low-cost carriers began to collectively spiral downwards year after the legacy carriers' introduction of basic economy. The low-cost carriers were looking less special by the quarter entering in the late 2010s. Before COVID, United, Delta, and American were laggards, while the low-cost carriers had led the way, with the ultra-low-cost carriers having the best margins. But post-COVID, the pendulum has swung back as the legacy carriers have shown the greatest resilience, while the low-cost airlines have struggled to return to profitability despite posting record highs in revenue. United and Delta built on their momentum through the pandemic by strategically giving up billions of ancillary revenue in the short term. Southwest historically was the only American airline that allowed passengers to change flights without penalty, but with legacy carriers now waiving the same fees, flexibility has become an industry standard. Throw in the continued investment in international alliances, credit card programs, frequent flyer benefits, exclusive lounges, and there's progressively less incentive for passengers to consider one-off travel with the lowest bidder and greater upside for their loyalty. These are all, critically speaking, easy bets for the legacy carriers, who all uniquely benefit from having a near monopoly control over travel to Europe and Asia. The high-margin international business is why United and Delta consistently outperform even American airlines, as AA's fortresses are largely limited to servicing Latin America. With the competitive advantage eroded, the situation has turned dire for Southwest, JetBlue, Spirit, and Frontier, all of whom are now lashing out in their own way that the industry is nothing more than a rigged turf war where the first movers with coastal fortresses will always win. JetBlue is currently in an identity crisis, and they're stuck between being a low-cost carrier that's no longer meaningfully cheap enough and a premium airline that's not reliable or expansive enough for business travel. Southwest, despite a string of operational incidents, has weathered the storm with its first-mover advantage, but its future is equally hazy. There's two schools of thought. One is that the generous baggage policy and the absence of ancillary fees is why the airline has remained so popular and by extension profitable year over year. Yet there's a growing counter-argument that the billions of dollars lost from not charging ancillary fees has not and will not help Southwest combat increasing fuel and labor costs, all of which ultimately constrain the cash flow and reduce the airline's ability to grow. Spirit and Frontier have been hit the hardest, as the ultra-low-cost model is no longer viable when every other airline is doing some form of it. The savings are no longer great enough to justify the inconvenience or experience, especially as the delta of total passenger cost between airlines has shrunk over time.